Welcome back to the channel, Future Financial Strategists. Today, we're diving deep into the fascinating world of hard-to-borrow stocks and potential short squeezes. We'll be breaking down a very specific company that recently caught our eye, WLDS, or Wearable Devices Limited. We'll explore why its cost to borrow is so high, what that could mean, and what factors you need to consider. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show WLDS logo/chart. Let's get right into Wearable Devices Limited, ticker symbol WLDS. This company operates in the innovative technology and consumer electronics sector, specifically focusing on developing a non-invasive neural input interface. Think about controlling digital devices like consumer electronics and smartwatches using subtle, touchless finger movements through their modular development kits. It's cutting-edge stuff. Currently, WLDS has a market capitalization of just $5.05 million, placing it firmly in the microcap category, which often means high volatility. Looking at the recent price action, it's been a bit of a roller coaster. Show price chart today, WLDS is down 12.36%, and over the last 5 days, it's dipped 14.66%. However, zoom out to the last 30 days, and WLDS has actually seen a gain of a remarkable 51.33%. Volume has also been significant today, with 6,913,800 shares trading hands, which is double its 30-day average volume of 3,413,103 shares, giving it a relative volume of 2.0x. This suggests heightened interest and activity around the stock. What is cost to borrow and why it matters? So, why are we talking about WLDS today? It popped up on our hard-to-borrow screen because of its incredibly high cost to borrow, or CTB fee. But what exactly is CTB? Simply put, it's the annualized interest rate short sellers must pay to borrow shares they want to sell short. Think of it like renting a car. If a specific car model is in high demand and there are very few available to rent, the rental fee shoots up. The same principle applies here. A high CTB indicates that there's intense demand to short a stock, a very limited supply of shares available to borrow, or both. These fees can go well above 100% annually because they compound daily, making it incredibly expensive for short sellers to maintain their positions. Why the stock is hard to borrow right now? For Wearable Devices Limited, the CTB fee is an astonishing 714.6% annualized. Highlight CTB number, let that sink in. Short sellers betting against WLDS are paying over 700% per year just to hold their positions. This immediately tells us a few things. Available shares to borrow are likely extremely scarce, and there's significant demand to bet against the company. With an estimated float of just 1.9 million shares, WLDS has a very small public float, which can make it easier for borrow rates to skyrocket when demand to short is high. While we don't have current data on the exact number of shares available to borrow, a CTB like this almost guarantees it's incredibly low, if not zero. Our internal composite squeeze score for WLDS currently stands at 42.3 out of 100, which is a moderate score, indicating notable but not extreme squeeze potential based on a combination of factors. It's crucial to remember, however, that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have incredibly strong conviction in their bearish thesis and are willing to pay a premium to stay short. Squeeze mechanics explained. So, how does a short squeeze work in a scenario like this? Imagine a large number of investors have borrowed WLDS shares at the insane 714.6% fee, hoping the price will drop. If, for any reason, the stock price starts to climb, perhaps due to positive news, increased buying pressure, or even just general market momentum, these short sellers start losing money rapidly. Not only are their positions underwater, but they are also bleeding money daily from the high borrow fees. At some point, the pain becomes too great, or they receive a margin call, forcing them to buy back shares to cover their short positions. This buying action then pushes the stock price even higher, which in turn triggers more short sellers to cover, creating a cascading effect of short squeeze. With WLDS's tiny 1.9 million share float, even a modest amount of false covering could have a dramatic impact on the share price. Dilution risk check. Before getting too excited about squeeze potential, it's always critical to check for dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This can reduce the value of existing shares and, critically for a short squeeze thesis, it provides short sellers with new shares to cover their positions without driving up the price, or it can simply overwhelm any buying pressure. For WLDS, we found no recent dilutive SEC filings such as SMINUS1, SMINUS3, or 424B forms in the last 90 days. We also found no recent reverse splits in our look-back window. This is a positive sign for a potential squeeze scenario, as a lack of recent dilution means there isn't an immediate flood of new shares that could temper any upward price movement. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For WLDS, if you're watching this situation unfold, here's what to keep an eye on. First, continued price action. Any sustained move upwards, particularly on higher volume, could put pressure on short sellers. Second, monitor the borrow rates and available shares. Are the fees staying astronomically high or even increasing? Is the supply of shares to borrow shrinking further? Third, watch for any company-specific news from Wearable Devices Limited. A new product announcement, a partnership, or strong sales figures could be the catalyst that shifts sentiment. Remember, high CTB means someone is paying a lot to bet against the stock. They might be right, or they might be setting themselves up for a painful exit. This is a high-risk, high-reward environment. So, Wearable Devices Limited WLDS presents an intriguing case study with its astonishing 714.6% annualized cost to borrow and a tight float of only 1.9 million shares. While it's seen a significant 51.33% gain over the last 30 days despite recent dips, and there's no immediate dilution risk, a high CTB is just one piece of the puzzle. Understanding these dynamics is crucial for anyone interested in the mechanics of the market. We hope this deep dive into WLDS helped demystify the concepts of hard-to-borrow stocks and short squeezes. If you found this information valuable, please hit that like button, subscribe for more unique stock breakdowns, and let us know in the comments below what other hard-to-borrow stocks you'd like us to analyze next.